Welcome to the deep dive.
Glad to be here.
Our mission is pretty simple. You bring us the source material, and today, that's excerpts straight from a major automotive company's 2024 annual report. And we cut through the noise.
Yeah, we extract the key insights,
Yeah.
get you informed fast.
Exactly. It's your shortcut. We'll pull out the surprising facts, maybe have a little fun, but stick to what the source says.
And today's source is their official 2024 Form 10-K. This is really important. It's how the company officially tells the public and regulators about its business.
Performance, structure, financial health, and importantly, the risks they see coming down the pike. It's their own words.
Straight from the horse's mouth, so to speak.
And this company, well, they've been making some really big moves lately, big strategic shifts. You see this pivot towards electric vehicles, EVs.
Right, a major focus.
And also really doubling down on their commercial business, Ford Pro.
Absolutely. And what's fascinating, and what we'll dig into, is how these, high-level strategies, they show up directly in the numbers, and even how they describe their different business units in this report.
Okay, let's start there then. Unpack that structure, because they've specifically organized themselves now into these distinct segments.
Exactly. It reflects the strategy. Think
Yeah.
of it like breaking the company into pieces
Yeah.
based on what they sell and who they sell it to.
Right, so you've got Ford Blue, Ford Model E, Ford Pro. Those are the main car bits.
Those are the core automotive segments, yeah. Then you also have Ford Next, that's sort of future tech, new investments.
Right, the incubator.
And Ford Credit, which is huge, the financing arm.
Okay, so focusing on those core three, just based on the report, what is Ford Blue?
Ford Blue is, well, it's largely the traditional business, internal combustion engines, ICE, and hybrids, primarily for retail customers, regular car buyers.
Huh.
It also holds most of the manufacturing assets for those ICE and hybrid vehicles. Even if an EV shares the plant floor, the ICE hybrid part is sort of under Blue.
Oh, yeah.
And purchase regulatory credits live here, too.
Got it. The established foundation. Then there's Ford Model E. That sounds electric.
It is. That's their dedicated EV segment. It covers the electric vehicles themselves, plus related parts, accessories, and, importantly, digital services for retail.
So the tech side, too.
Yes, this segment is responsible for developing all the EV tech, digital platform software. It also manufactures certain EVs, including some that actually get sold through Ford Pro,
Ah, okay.
and the manufacturing plants that are only or primarily making EVs. Those assets sit within Model E. They operate in North America, Europe, China, handle some EV sales to commercial folks in those regions too.
So Model E is the EV innovation hub, the development engine, and an EV manufacturing arm. Now, Ford Pro, that one's been getting talked about a lot.
Okay.
Good performance.
Phenomenal performance, as we'll see. Ford Pro is all about the customer type, commercial, government, and rental customers globally.
Okay, so less about what powers the vehicle.
Exactly. The core is commercial services, plus the vehicles these customers buy. And crucially, that includes ICE vehicles, hybrids, and the EVs made by Model E, but sold to these Pro customers.
Interesting. So the EV ends up in Pro's results if it's sold to a fleet, for example.
Right, and the associated costs follow, like allocated regulatory expenses based on that vehicle line.
So Pro is customer-focused, bundling services. And then Ford Next is future stuff. Ford Credit handles the money side. That structure makes sense now.
And now let's look at how they actually performed financially in 2024. The report gives us EBIT figures, earnings before interest and taxes for each segment.
And this is where you really see that strategy playing out in dollars and cents, right? The contrast.
Oh, the contrast is stark, absolutely.
Yeah.
Let's start with Ford Blue, the traditional side.
Okay.
They reported EBIT of $5,284 million in 2024.
Which sounds like a lot, but how does that compare?
It's down, significantly down from $7,462 million in 2023. That's a drop of $2,178 million.
Wow. Why such a big drop?
Well, the report notes wholesale units were down 2%, partly because they stopped making models like the Fiesta in Europe and the Edge here.
Right. End of life for those.
Though trucks like the Ranger and Bronco saw increases, offsetting some of that. Revenue was actually flat year over year, despite fewer units sold.
How does that happen? Fewer sales, same revenue?
Favorable currency pricing, particularly in South America, helped, and higher sales of components to other companies, but that was offset by unfavorable exchange rates elsewhere.
So flat revenue, but profit still fell quite a bit. What were the main drags on profitability for Ford Blue?
They spell it out. Volume and mix had a negative impact of over $1 billion, I guess $130 million. Costs were also negative $904 million. And exchange rates hit them hard, negative $1,194 million.
Ouch.
There was some positive from net pricing, about $732 million, but nowhere near enough to cover those other hits.
Okay, so a tough year for the traditional Ford Blue business. Now let's look at Ford Model E, the big EV bet. How did that do?
Well, Ford Model E reported an EBIT loss, a significant loss.
How significant?
$5,076 million in 2024, a loss of over $5 billion.
$5 billion. And how does that compare to the year before? Did it get better?
No, it actually got worse. The loss widened from $4,701 million in 2023. So the loss increased by $375 million.
Wow. Okay, so growing losses in the core EV segment, that really underscores the sheer cost of this transition right now, doesn't it?
It really does. The investment is massive. And that contrasts sharply with the third leg, Ford Pro.
Right, the commercial side, what did their EBIT look like?
It couldn't be more different. Ford Pro generated EBIT of $9,015 million in 2024. $9 billion.
$9 billion. And compared to 2023,
That's way up. It was $7,222 million in 2023. So an increase of almost $1.8 billion, $1,793 million to be exact.
okay, so let me just recap this because it's striking. Ford Pro, massive profit engine, growing strongly. Ford Blue, traditional business, profitable but declining under pressure. Ford Model E, huge investment, currently bleeding cash with widening losses.
That's the picture the report paints. Absolutely. The difference is fascinating and really central to understanding the company's current situation and challenges.
You can see how complex it must be to manage that internally, one part funding the other, essentially.
One part is carrying a very heavy load, while another requires that massive investment and is, for now, deeply unprofitable.
Okay, let's zoom out then. Look at the overall company financial picture, the consolidated view beyond just those segments. What did the report say about total company profit?
Right, so on a consolidated basis, net income attributable to the company was $5,879 million in 2024.
Wait, net income was $5.9 billion, but Model E lost $5 billion and Blue was down. How did that add up? Oh, Ford Pro's profit and Ford Credit.
Exactly. Ford Pro's huge profit, plus the contribution from Ford Credit, more than offset the Model E loss and the decline in Blue. And interestingly, that net income figure was actually up from $4,347 million in 2023.
Net income went up, but they also talk about company-adjusted EBIT,
Yeah.
right? How did that look?
Right, that's a metric analysts often watch closely. Company-adjusted EBIT was $10,208 million in 2024.
Okay, $10 billion. And compared to 2023.
That was slightly down. It was $10,416 million in 2023. So a small decrease of $208 million in adjusted operating profit.
So hold on, net income went up, but adjusted EBIT went down slightly. What explains that difference?
Yeah, the report points directly to special items. These are things considered one-time or unusual.
Okay.
In 2024, they had $1,860 million in pre-tax special item charges. This included things like a write-down on a canceled electric SUV program.
Killing a future product.
Exactly. Restructuring costs in Europe, buyouts for hourly workers in North America. There was a partial offset from pension and other post-employment benefit accounting changes, but the net effect was these large charges.
So those charges hit the net income number, making it lower than it otherwise would be, but they get excluded from adjusted EBIT to show the underlying performance.
Precisely. It gives a clearer view of the ongoing core business trends, stripping out those unusual items.
Makes sense. Okay, shifting to the balance sheet. What did their assets and liabilities look like at the end of 2024? Any key numbers jump out?
Well, on the consolidated balance sheet, cash and cash equivalents stood at $22,935 million. So almost $23 billion in cash.
A decent cushion. What about inventory?
Inventory, excluding Ford Credit, was $14,951 million, nearly $15 billion.
And on the other side, the liabilities.
Consolidated total current liabilities, things due relatively soon, were $106,859 million. And total liabilities overall were $240,338 million.
Whoa, $240 billion in total liabilities. That's a big number. How did that impact the company's equity, the net worth?
Equity attributable to the company actually went up. It was $44.8 billion at the end of 2024, which is an increase of $2.1 billion from the end of 2023 when it was $42.7 billion.
Okay, so equity grew despite the liabilities. Now, cash flow. Where did the actual cash come from and where did it go in 2024? Always important to follow the money.
Right. So net cash provided by operating activities, cash generated from the day-to-day business was $8,955 million, almost $9 billion.
Okay, positive cash from operations. Investing.
That was a big outflow. Net cash used in investing activities was $24,370 million.
Over $24 billion spent on investing. That's huge. What were the main things they were spending on there? Building things.
Primarily, yes. Cash outflows for property and equipment purchases. That's building new factories, retooling plants for EVs,
Okay.
buying machinery, and also cash flows related to finance receivables, which ties into the Ford credit side.
Okay. And financing activities, where did cash come from or go there? Debt, dividends.
Financing activities actually provided cash overall. Net cash provided by financing activities was $7,485 million.
So they brought in cash through financing. How?
Primarily from things like issuing new debt, which brought cash in, though this was partially offset by paying down some existing debt. But it also includes significant cash outflows for shareholder returns.
Ah, dividends and buybacks.
Exactly. The report shows cash payments for dividends were $3,118 million in 2024, and purchases of their own common stock buybacks used $426 million in cash.
Okay, so issuing debt brought in more cash than they paid out in dividends and buybacks in that category.
For 2024, yes, that was the net effect in the financing section.
You mentioned Ford Credit a few times. Let's dive into that segment a bit more. It's obviously critical for actually selling cars.
Yeah.
What does the report tell us about its structure and health?
Yeah, Ford Credit's main job is supporting vehicle sales. They provide financing for dealers to hold inventory and for customers to buy or lease cars. At the end of 2024, its net receivables, the amount owed to them, was a massive $143.6 billion.
And how do they fund that? Where does Ford Credit get the money to lend out?
Primarily through debt. The report breaks it down. $59.2 billion came from term unsecured debt, right, to corporate bonds, and another $60.4 billion came from term asset-backed securities.
Okay, term asset-backed securities, or ABS. Can
Yeah.
you break that down simply for listeners? What does that mean?
Sure. Think of it like this. Ford Credit has all these car loans people are paying off. Those loans are assets. They bundle thousands of those loans together into pools. Then they sell securities, kind of like bonds, to investors, where the payments on those securities come from the cash collected from the bundled car loans. It's a way for Ford Credit to get cash up front instead of waiting years for loans to be repaid.
So they sell off the rights to the future loan payments, essentially.
In a way, yes. It's called securitization. It helps them manage their funding needs and keep lending. The report notes that this securitized funding made up 43.8% of their total debt at the end of 2024.
Got it. A key funding tool for them. How did their overall liquidity look? Could they meet their obligations?
Yeah, they report strong liquidity figures. At year-end 2024, total liquidity sources were $53.9 billion. Available liquidity was $24.7 billion, and net liquidity available for use was $25.2 billion.
Okay, seems stable. But what are the big risks they specifically call out for Ford Credit? What worries them?
The report highlights several key risks. One is higher than expected credit losses, people not paying back their loans. This is sensitive to the economy, unemployment, income growth, but also used car prices.
Used car prices, how does that affect loan losses?
If someone defaults and they repossess the car, what they can sell it for matters. If used car prices fall sharply, their losses are bigger.
Huh. Okay, what else?
Another critical risk, especially now, is lower than anticipated residual values for leased vehicles.
Residual value, that's the predicted value of the car at the end of the lease.
Exactly. If cars are worth less at lease end than they predicted, Ford Credit takes a hit. This is affected by the economy, marketing programs, but the report specifically calls out the impact of changes in propulsion technology.
Meaning the shift to EVs.
Precisely. There's uncertainty about how quickly used EV values might fall compared to traditional gas cars, especially as new EV tech comes out. If EV residuals drop faster than expected, it hurts Ford Credit's lease portfolio. Higher return volumes on leases are also a risk.
So that EV transition risk isn't just about Model E's manufacturing costs. It directly hits the financing arm through potentially lower used car values down the line.
It absolutely does. It's interconnected.
How do they account for these potential loan losses? Do they set money aside?
Yes, they maintain an allowance for credit losses. This is their best estimate of the expected lifetime credit losses across their entire loan portfolio. They reassess it every quarter using financial models, but also management judgment, factoring in the economic outlook and how loans have been performing recently.
This really raises a key question then, doesn't it? How much does the financial health and particularly these risks within Ford Credit, like that uncertainty around used EV values, impact the whole company's ability to actually sell cars?
It's a huge link.
I mean, if credit gets tighter because losses are rising, or if lease payments have to go up because they're worried about residual values plummeting, doesn't that directly dampen demand on the Ford Blue and Model E side?
Absolutely.
Hmm.
Financing availability and affordability are fundamental drivers of car sales, especially for big-ticket items like vehicles. If the finance arm gets squeezed or becomes more risk-averse, it acts as a brake on the core automotive business. It's a critical feedback loop, especially in a market with evolving tech and economic uncertainty.
Okay. Shifting gears slightly, but related to the financials. What does all this activity mean for shareholders, people who own the stock, or potential investors? Does the report detail how the company plans to return value to them?
Yes, it does. We saw the numbers briefly in the cash flow statement, but they provide details. There were direct cash outflows specifically for shareholder returns.
Like dividends?
Yes. In 2024, they made cash payments for dividends totaling $3,118 million. Over $3 billion returned directly to shareholders as dividends.
And were they also buying back their own stock? That's another way to return value.
They were. They spent $426 million on purchases of common stock share buybacks in 2024.
Do they give any specifics on the buyback program?
They do. They mentioned a specific publicly announced plan under which, in November 2024, they bought 13.7 million shares. The average price was $10.91 per share.
Okay.
And as of the end of 2024, the report states they still had authorization to purchase another 16.57 million shares under their existing buyback plans.
So you see both dividends and share repurchases actively being used, and the report quantifies the cash spent and the number of shares involved. Clear actions to return capital.
Exactly.
All right, let's pivot now towards the future. Based on what the company itself is saying in this report, what are the really key factors shaping their business moving forward? The opportunities, sure, but maybe more importantly, the challenges and risks they see. This is where it gets really interesting, I think.
I agree. This section really lays out the landscape they have to navigate, and the regulatory environment is, well, incredibly complex.
Yeah, you hear about emission standards all the time.
It's that and much more. Strict, often changing regulations globally, safety, emissions, fuel economy, zero-emission vehicles or ZEVs, noise, even recycling. It covers everything.
And those ZEV mandates, especially in places like California, seem like a huge driver.
They absolutely are. The report highlights California, mandating 22% of light-duty sales must be ZEVs by 2025, ramping up to 35% in 2026, and then a huge jump to 100% by 2035.
100% by 2035 in California. And other places follow.
Many states opt in to follow California's rules. Canada also has aggressive mandates, aiming for 100% ZEVs by 2035 too, and they expect to align with new U.S. EPA standards. Quebec and BC also have 100% mandates by 2035.
What about Europe? They're pushing hard on this too, right?
Yes. Euro 7 standards are phasing in soon, increasing stringency. They also mention potential complications from post-Brexit divergence in rules and something called the Carbon Border Adjustment Mechanism, CBM.
CBM.
Yeah, starting around 2026, 2027, it could effectively put a tax on imported materials like steel and aluminum based on their carbon footprint, potentially increasing costs.
Wow. Just navigating that patchwork of evolving rules must be a massive challenge.
It is. The company explicitly states compliance is costly, and it's made harder by sudden or frequent changes, things like waivers being granted or revoked, court decisions, shifts in government priorities, especially in the U.S.
And can they even meet these targets?
That's the crucial point they make. Their ability to comply heavily depends on the market actually supporting EVs. You need the technology to be ready. You need government incentives to help with cost. Vehicles need to be affordable. And critically, you need widespread, reliable charging infrastructure.
So if those market conditions aren't there,
Then meeting the mandates becomes incredibly difficult and very expensive, potentially requiring them to buy costly credits from competitors like Tesla.
okay. Regulations are one huge factor. What about the physical supply chain, especially for EVs? Batteries.
Absolutely critical, and a major risk highlighted in the report. They are highly dependent on securing enough battery supply. And not just batteries, but the raw materials that go into them, lithium, cobalt, nickel.
Which everyone wants now.
Exactly. As EV production ramps up industry-wide, the demand for these materials is expected to skyrocket. They face intense competition. There's a real risk they simply can't get enough, or can't ensure it's responsibly sourced, or that the price becomes unreasonable.
And they mention using things like long-term purchase contracts to try and lock this stuff down.
Yes, these offtake agreements and long-term contracts are necessary tools to try and secure supply. But they come with their own risks. What if future demand for EVs is lower than they contracted for? Or what if costs fluctuate wildly in ways they couldn't predict?
A double-edged sword.
And it's not just batteries. They note that for many components across all vehicles, they rely on single or very few suppliers. If one of those suppliers has a problem, a fire, a financial issue, anything, it can halt production because resourcing complex parts quickly is very difficult. Plus, cars are just getting more complex, which increases the risk of production delays during model changeovers.
So just building the cars is fraught with supply chain risk. What about selling them? Market acceptance, competition.
Another huge area of focus and risk, whether customers will actually embrace their new products, especially the EVs, and increasingly the digital and software services they're pushing, is not guaranteed.
Competition must be fierce.
Intense. Not just from the usual suspects, the other big automakers, but also new entrants. Think Tesla, Rivian, maybe tech companies getting into this space, particularly on the digital services side.
So how do they plan to compete?
They state they need to differentiate their products and services effectively to avoid just competing on price, which erodes profits. If demand isn't strong enough for their offerings, they could end up with too much inventory, forcing price cuts and making factories less efficient.
And if they don't have enough supply,
Then customers might just go to a competitor who does. It's a balancing act. A specific challenge they call out is around those digital services. Can they actually develop and deploy secure services that customers find appealing enough to subscribe to?
the subscription revenue dream.
Right? They've invested heavily, but their plans to grow that recurring revenue are at risk if people don't sign up or activate the services.
They also use partnerships a lot, right? Strategic alliances, joint ventures, especially for new tech like batteries or autonomous driving. What risks do those bring?
The report is quite clear. These partnerships involve significant risk. They might not deliver the expected benefits or could face delays due to complexity, needing more capital than planned, regulatory hurdles, problems integrating operations, or just partners having different goals.
Any examples?
They give a very concrete one. Their exit from the Argo AI joint venture, which was focused on autonomous driving, that resulted in a $2.7 billion impairment charge back in 2022, and Argo AI ultimately dissolved in 2024.
So a big bet on future tech through a JV that didn't pan out.
Exactly. It highlights the potential downside of these investments in emerging, unproven technologies, even with partners.
And even for securing raw materials through partnerships or investments.
Those might also fall short of expectations. And they mention the difficulty of influencing suppliers on things like sustainability standards, especially in less developed markets, which could create reputational risk.
Interesting. They also mention human capital, their workforce.
Yes, briefly. They talk about striving for an inclusive environment, using employee surveys and focus groups to understand challenges, adjusting benefits to stay competitive, and fostering a culture of care. Basically, acknowledging their people are key to navigating all this change.
Okay. Government incentives came up with regulations, but they mention the U.S. Inflation Reduction Act, the IRA specifically as well.
Right. They note they've benefited from incentives in the past, like in Brazil, though that can sometimes lead to later tax disputes. But the IRA in the U.S. is seen as a major potential benefit.
How so?
It provides significant tax credits aimed at boosting the domestic EV supply chain, U.S. manufacturing of EVs and batteries, and also credits for consumers who purchase qualifying EVs. They expect this to benefit the company and their battery joint ventures, like the Blue Oval SK partnership.
But there's a catch, right? There's always a catch.
A big one. The report explicitly states the benefits depend on the IRA remaining in its current form. There's political risk, potential repeal, or changes that restrict eligibility.
And actually qualifying isn't simple either.
No. Eligibility for many credits depends on meeting complex requirements for developing a domestic supply chain, sourcing battery materials from specific countries, and navigating detailed regulations and limitations. They state it could take years to fully satisfy all the new criteria.
So it's a potential advantage, but uncertain and complex to achieve.
And automakers who figure out how to optimize their eligibility faster will gain a competitive edge.
What about ongoing operational risks, like warranties?
Yep, warranty costs and field service actions are mentioned. They accrue estimated costs when vehicles are sold and regularly check if those reserves are adequate. They do note that costs could increase, especially with rising vehicle complexity and new technologies in EVs and software.
And funding risks for the main company, beyond Ford Credit, interest rates.
Yes, their ability to borrow money in the debt markets is affected by their credit ratings, general market volatility, and regulations. Rising interest rates obviously make borrowing more expensive, They use financial tools, derivatives, to try and hedge some of these risks, like foreign currency fluctuations, commodity price swings, and interest rate changes.
Makes sense. Finally, what about litigation? Always a factor for a big company.
It is. They face various legal actions and claims all the time, product defects, warranties, regulatory issues, tax disputes, employment matters, you name it.
Anything specific called out?
They specifically mention ongoing asbestos litigation. This primarily relates to claims from mechanics doing brake work years ago. While the company defends its position based on scientific evidence, they acknowledge that the potential financial exposure is difficult to estimate and could become significant. They have set aside funds, accruals, for probable losses from both current and potential future asbestos claims.
Okay. So, pulling it all together from their own report, you really see a company deep in a massive transition. You've got the Ford Pro commercial side firing on all cylinders, generating strong profits.
Which is crucial because it's helping to fund the huge investments and offset the current significant losses in the Ford model electric vehicle segment.
Meanwhile, the traditional Ford Blue business, while still profitable, is facing serious headwinds and declining profitability.
And all of this is happening against this incredibly complex backdrop we just discussed. Rapidly changing global regulations, intense supply chain pressures, especially for batteries, fierce competition from old and new players, and a whole host of operational, financial, and even legal risks that they themselves are clearly identifying.
Understanding these different parts, Blue, Model E, Pro, credit how they perform individually, and the external challenges the company spells out. It gives you, the listener, a much clearer picture of their strategy.
You can see where it's working, where the hurdles are, and what factors could really impact their future performance. And ultimately, that influences the kinds of vehicles they build, how much they cost, the technology they prioritize, and the overall health of the company.
So here's something to think about. Given that stark difference, we saw Ford Pro's strong profitability versus Model E's widening losses and layering on all those complex challenges, like navigating ZEV mandates globally and securing critical battery materials. How exactly will this company manage that financial tightrope walk? How do they keep funding this massive, extensive tech transition while keeping the profitable parts running smoothly and satisfying shareholders? And what might that intense pressure ultimately mean for the timeline and maybe the cost of the future vehicles, especially EVs, that you might see on the road?